Assalamu alaikum class. In this lecture, I will discuss two popular depreciation method. One is a straight line method and another is declining balance method. We will also work through practice questions from the book Financial and Managerial Accounting by Williams Haka Bettner, which is also known as Meigs Accounting. So let's get started. First of all, we will discuss what is depreciation. Depreciation is the process of allocating the cost of a tangible assets over its useful life. You can say tangible assets or any fixed assets or long-term assets over its useful life. It reflects the reduction in the value of asset as it is used over time. Depreciation basically ensures that the cost is spread out over the years the asset is in use. So that's why it's reflect the true value of assets on the balance sheet. Here you can see that whenever we purchase or acquired an asset, we record it in the balance sheet with the cost amount. And as we use or as the services are rendered or services are received from that particular fixed asset, the cost of the asset is converted into expense, which is called depreciation expense. So that's why we call the allocation of cost over its useful life is basically the depreciation expense. So we have two different types. First of all, the straight line method of depreciation. This it is one of the simplest and most commonly used methods to allocate the cost over its useful life of the asset. Depreciation or through straight line method. In this method, basically the cost of an asset evenly spread over the useful life. Evenly means we calculate depreciation amount and that amount is same for each year till the life of the asset. So the same amount of depreciation expense is recorded, making it easy to calculate and apply. In depreciation, while calculating depreciation expense, we have cost, residual value, and years of useful life. So, what is cost? Cost is basically the amount or to which we purchase the asset. In the last lecture, we have calculated and we learned to calculate the cost of asset. The cost of assets include all the capital expenditure that are necessary or that are directly related with the purchase of any fixed asset. Residual value is basically the estimated value of the asset at the end of the useful life, and the number of the years is the useful life, the number of the years the asset is expected to be in use. In simple word, it is used for the asset when the asset is expected to provide equal benefits or the same benefits over its entire useful life. Whereas the other method is declining balance method. Declining balance method is depreciation in the early years of an asset's estimated useful life is higher than the later year. Or in simple word, we can say that um, basically in this method, depreciate an asset more in the earlier years of its useful life compared to the later years. Basically, this is used for that assets that lose value more quickly when they are newer and more efficient. So this method is suitable for assets that lose value quickly or have higher productivity in the initial years. So This is the table which is necessary for calculating decline balance method depreciation. Here you can see the depreciation column. In the earlier years, the depreciation amount is much higher as compared to the later years. You can see that first year the amount of depreciation is 9600, then 5700, then 3000. So that's why this method is called declining balance method, because the depreciation expense are declining um, in the later years as compared to the earlier years. So let's discuss in detail these methods from the book Williams Haka Bettner, Financial and Managerial Accounting. An example is a brief exercises 9.2. So we are covering exercise 9.2. In the brief exercise 9.2, we have a building cost 4 lakh or $400,000. Straight line method is used for calculating depreciation, and 2 years depreciation is required, whereas 25 years of estimated useful life is given, and 1 lakh or $1,000 residual value is given. So in the first requirement, annual depreciation is required for the first 2 years, and in the requirement two, book value is required at the end of the second year. So depreciation, first of all, annual depreciation can be calculated by the formula cost minus residual value and divide by useful life. So in this case, we have 4 lakh or $400,000 cost. We can check the cost is given, the residual value is given, and the useful life is given. So we can calculate yearly depreciation. 400,000 minus $100,000 divided by life is 25 years. So the annual depreciation would be, okay, it is divided by this amount. So we are going to divide it, and the amount is $12,000. This $12,000 is basically the depreciation, which is per year. And we have just discussed that in the case of a straight line method, this depreciation remains constant for all the remaining years of all the useful life of the asset. So come to the requirement, and requirement is to calculate depreciation expense for year one and year two. So we have depreciation expense. Year one, same to 12,000. Year two, 12,000. Year three, 12,000. Year four, till 25th year, the depreciation would be 12,000, because this is the straight line method. What is accumulated depreciation? So accumulated depreciation basically means to accumulate or to add up or to sum the depreciation, the current year depreciation and the previous year depreciation. So as this is the first year, so we have just current year depreciation. We do not have previous year depreciation. And how we calculate book value? In book value, we simply calculate, we have cost of the asset and we deduct accumulated depreciation. So accumulated depreciation is 12,000. So 3 lakh 88,000 is the um, book value of the asset at the end of the year one. Whereas accumulated depreciation year two is the current year depreciation and the previous year's depreciation. So the 12,000 plus 12,000. So accumulated depreciation is 24,000, and the book value is, now we have just discussed, cost minus this is the accumulated depreciation, which is 24,000. So this is the book value of the assets. That's it. This was the requirement number 2 to calculate the book value. So we have calculated 2 years depreciation, which is required in one requirement, and second year book value, which is required in part B. So next example is brief exercise 9.3, and in 9.3, what data is given? We have cost of the equipment, which is 24,000. So here it is the cost of the equipment, 24,000. And the company is considering whether to determine annual depreciation using straight line or declining balance method. Means company is considering both of the method. The company or the company has to decide which method is better, the straight line method or the declining balance method at the rate of 150% of the straight line rate. Okay, so 150% of the straight line rate. This is the declining balance method. So we will have to calculate first of all a straight line rate, and then we multiply 150% of that straight line rate. The next data is given. The life is 10 years, salvage value is 4 years, and what is required, basically the comparison of these two alternatives is required. So comparison means we will calculate 2 years depreciation through straight line method, and then we will calculate 2 years depreciation by declining balance method at 150% of the straight line rate, and then we will compare the depreciation expense of these two methods. So let's start. First of all, straight line method. Straight line method annual depreciation is, we have discussed, cost, which is 24,000, minus salvage value or residual value, which is 4,000, divide by useful life, which is 10 years. So the depreciation would be, the annual depreciation would be 2,000 per year. 2,000 per year at straight line method. Year one and two. So year one and two, we have depreciation expense, we have accumulated depreciation, and then we have a column of book value. This is for just for the comparison purpose. So depreciation, as in a straight line method, the depreciation amount remains same throughout the useful life of the asset. So we have taken just 2,000 and 2,000. Accumulated current year 2,000, second year we have 1,000 previous year depreciation, and sorry, 2,000 previous year depreciation and 2,000 current year depreciation. Total depreciation is 4,000 accumulated depreciation. How do we calculate book value? Book value, we have cost of the asset and minus accumulated depreciation. So this is the book value at the end of the first year. At the end of the second year, we have cost, but depreciation, accumulated depreciation is 4,000. So this is the book value at the end of the second year. Now, the requirement number 2, uh, we calculate again depreciation expense, but the method is declining balance method at 150% or straight line rate. So first of all, we will have to calculate straight line rate. The formula of the straight line rate is 100% divided by useful life. So 100% divide by useful life is 10 years. So 10 years by dividing 100% by 10 is 0.1, or you can say in terms of percentage 10%. So straight line rate is 10%, whereas reducing balance rate is 150% of the straight line rate. So 150% of the straight line rate, which would be 15%. So 15%. So declining balance rate is 15%, which is 150% of the straight line rate. Now we are going to prepare table, year depreciation expense, then we have accumulated depreciation, and then we have book value. So first year and the second year. First year, the depreciation will be calculated on the cost, directly on the cost, because we do not have any previous depreciation. So there's no concept of book value in the year one. So we have depreciation expense. 24,000 is the cost multiplied by rate, which is 15%. So first year, the depreciation is 3600, and accumulated depreciation is also 3600, whereas book value is cost minus accumulated depreciation, which is 3600. So this is the book value. In the second year depreciation, we take book value 20400 multiplied by rate, and rate is 15%. Declining balance rate, which is 150% of a straight line rate, which is 15%. We have just calculated 15%. So second year depreciation is 3060. Accumulated depreciation, first year depreciation plus second year depreciation. So this is your accumulated depreciation, whereas book value is cost minus accumulated depreciation, which is 0006. So this is the book value. Now, comparison is required. Comparison is required. We have year 1 and 2. We have depreciation under straight line method, and we have depreciation under declining balance method. Okay, so depreciation, uh, you can say, if we write it here, declining balance method, first year depreciation, we can see the first year depreciation is 3600, second year 3060. Similarly, straight line method 2000 each year. So declining balance method, first year we have 3600, second year 3060, and straight line method 2000, then 2000. So what is the difference between them? Difference. First year, when we deduct depreciation under straight line method from depreciation under declining balance method, we get $1,600, which is higher than straight line method. Means depreciation expense under declining balance method is $1,600 higher than straight line method. And second year, when we deduct 2000 from 3060, then 1060, we get 1060. So second year, $1060 are higher in case of declining balance method as compared to straight line method. So this is the just comparison is required. So we compared both of the method, and you can see we have just discussed in introductory slide that straight line method means we have similar, or this we use straight line method for those assets whose benefits are equal throughout the useful life of the asset, whereas declining balance method is used where asset is used in earlier year, or assets basically depreciate in earlier years as compared to later years. So we have another example, brief exercise 9.4. $76,000 cost is given, and the company is using declining balance method, but there's a confusion that the company is not confirmed to use whether to use 150% or 200% of the straight line method. Means the company is using declining balance method, but the company has two options regarding the rate of declining balance method. So we have two different rates: 150% of the straight line method, and 200% of the straight line method. So we will have to compare two methods: declining balance method at the rate 150% and at the rate 200%. The other thing is useful life is given 8 years, which is necessary to calculate straight line rate. So with the help of 8 years, we will calculate straight line rate, and the prepare comparison of two alternative rates for management for the first 2 years. So first 2 years depreciation under each rate is required. So for this, first we will have to calculate straight line rate, and the formula is 100% divide by useful life. So 100% divide by, in this case, useful life is 8 years, so divide by 8, which is 0.12, or if we write it in percentage, the answer is two decimal places, 12.5%. So our answer is this 12.5% is a straight line rate. Now we have reduced declining balance rates, two different rates. Declining balance rate, first of all, is 150% of straight line rate, and other is declining balance rate, 200% of straight line rate. So in first case, 150% multiply by straight line rate. We have just calculated 12.5%. So the answer would be 18.7%. So 18.75%. And in case of 200%, so we multiply 200% multiply by 12.5. So this one multiply by 12.5, which is 25%. So 25%. So far, we have calculated, first of all, we have calculated a straight line method rate, straight line rate, which is 12.5%. And then we converted 150% and 200% into straight line rate. Here you can see that straight line rate, 50% or 200% of straight line rate. So we simply multiply 150% with 12.5 and 200% with 12.5 to get the reducing balance or declining balance rate, which is 18.75 and 25%. Now we are going to prepare the chart or the table. First of all, 150% declining balance method. We have years, then we have depreciation expense, then we have accumulated depreciation, and then book book value. So just 2 years depreciation is required. In declining balance method, we simply multiply cost by the rate. In first case, cost or you can say book value. So in 150%, the rate is 18.75%, and the cost is this one. The cost is also given. So depreciation expense would be cost. In case of year one, it is cost. In case of years after year one, it would be book value. So 76% multiply by 76,000 multiply by 18.75%. So this is the depreciation of year one. Accumulated is same. Uh, 250 because there is no previous year depreciation, and book value, the formula of book value is cost minus accumulated depreciation. So we have cost, which is 76,000, minus accumulated depreciation is 14 to 50. So this is the book value. On year two, we calculate depreciation on book value. We apply percentage, this 18.75 on book value. So book value is 61750 multiplied by 18.75%, which is, you can say, we have just 11,580, 578 is the depreciation. Accumulated means we are going to add these two. So accumulated depreciation is 14 to 50. We accumulate or we add all previous and current depreciation, which is 11,578, and this is your accumulated depreciation. What is book value? Book value is cost minus accumulated depreciation 828. So this is the book value in case if 150% declining balance method is used. If 200% declining balance method is used, so instead of 150, we have 2%, 200% depreciation. So 76,000 in case of 200%, we can see that the declining balance rate is 25%. So we take here in depreciation expense, while calculating depreciation expense, we take 25%. So 25%. The depreciation is 19,000. Accumulated is again 90,000, 19,000, and book value is 70,000, 76,000 minus 19,000. So this is the your book value. Second year, the book value is, we copied from this one, 57,000 multiply by 25%. This is our depreciation. Accumulated means we are going to add these two, means 19,000 accumulate in 4250. So this is accumulated depreciation. This is 19,000. And the book value is cost minus accumulated. Accumulated is 33250. Next thing which is required, the comparison of two alternatives rates. So now comparison year one and year two. For comparison, we have, first of all, we have 200% declining balance rate, and we compare it with 150% declining balance rate, and then at last uh, we will take difference so that we will compare it. Now see, uh, depreciation expense first year is 19,000. Second year is 14,250. So 14,250. Whereas in case of 150, we have 14,250. And next year we have 11,578. So when we deduct each other, like 19,000 minus 14,250, and then 14,250 minus 11,578. So the depreciation, the difference is in year one, when we use 200% declining balance method, the depreciation expense is $4,750 higher as compared to 150% declining balance method. And similarly, in case of second year, 260 200 $2,672 depreciation is higher in case of 200% declining balance method as compared to 150% declining balance method. So the comparison was required, and that's it from brief exercise 9.4. Our last exercise is 9.4 for today's lecture. So, the company is basically acquired a machine. Life is given 5 years. Cost of the machine is 40,000, and this 5,000 represent residual value. The main requirement is to calculate depreciation method under three of the and this depreciation method is full depreciation method, means all 5 years depreciation is required because life is 5 years. Straight line method, next requirement is 200% declining balance method, and third requirement is 150% declining balance method. But one thing is that a switch to straight line is required when it will maximize depreciation expense. So, what is required? We will calculate 150% declining balance method, but then we will switch to the straight line method in between. So, let's start. First of all, what we need is to calculate depreciation from straight line method. So we are going to calculate depreciation straight line method. Annual depreciation formula is cost minus residual value divided by useful life. So we have cost. Number one is straight line method, and the depreciation is cost minus residual value divided by useful life. So this is the formula: cost minus salvage value or residual value divided by useful life. In this case, the cost is 40,000. So we take 40,000 minus residual value, which is 5,000, divided by useful life, which is 5 years. So the straight line depreciation would be $7,000 per year. And now we have years, then depreciation, expense, then accumulated depreciation, and the last column is for book value. So 5 years life is 1, 2, 3, 4, 5. Depreciation, as we are using straight line method, so we have same depreciation all years. Accumulated, now we are adding one by one all depreciation of current year and the previous year, and 35,000. What is the book value? Book value is simple formula, cost minus accumulated depreciation. So cost is 40,000 minus accumulated depreciation is 7,000. So here in second year accumulated depreciation, you can see 14,000. So we deduct 14,000. In third year accumulated depreciation is 21,000. So we take 21,000. In 4 year accumulated depreciation is 28,000. So we take 28,000. In third year accumulated depreciation is 35,000. But we have 45, we have accumulated depreciation is 35,000. So we can see this 5,000 is remaining. So this 5,000 is what? Actually, this 5,000 represents your residual value. The definition of residual value is the amount or the value or the cost after the end of the useful life. So this should be the remaining book value after the end of the useful life. So this was the straight line method, first method. For the second method, first we will have to calculate declining balance rate. So for 200% uh, straight line rate, first we will calculate straight line rate, and the formula is 100% divide by useful life. 100% life is 5 years. So the rate would be 20%. So we can check it whether it is 20%. Yes, it is 20%. Then we will calculate 200%, 200% declining balance rate, and we simply multiply 200% into 20%, like we did in the previous example. So here, which is 40%, 40%. So this is 40%. Then we will repeat the same steps for 150%. And here we have 150%, and here we have 150%, which is 30%. Now, declining balance rate is 30% in case of 150 percent declining balance. Okay, so we are going to prepare a chart or table indicating depreciation expense and accumulated depreciation under 200% declining balance. So 200% declining balance method. We have years 1, 2, 3, 4, 5. Then we have depreciation, expense. Then we have accumulated depreciation, and then book value. So in first year we take cost because we cannot calculate book value in first year. And this is the cost and the rate is 40%. So cost is 40,000 multiply by 40%, 40%. So depreciation is 16,000 and accumulated depreciation is also 16,000 because we do not have any previous value. How you calculate book value? The formula of book value is cost minus accumulated depreciation, which is 16,000. So this is book value. Next year and every year after the first year, we will apply or we will take book value for calculating depreciation expense. So second year book value is 24,000. This one book value, we carry forward this book value, multiply by rate of the depreciation is 40%. So multiply it by 40%. Now depreciation is 9,600 accumulated. Now we are going to add these two, 16,000 plus 9,600. So this is your accumulated depreciation and book value is cost minus this accumulated depreciation, which is 225,600. So this is the book value at the end of the second year or at the start of the third year. So third year, the book value is 14,400 multiply by rate of depreciation, which is this 40%. So we multiply it by 40%. So this is the depreciation expense third year, and accumulated is 25600 plus current year depreciation, which is 5760. And the book value is cost minus this accumulated, which is 31,360,000. So this is the book value at the end of the third year or at the start of the fourth year. So fourth year, the book value is 8640 multiply 40% rate. So depreciation is this and accumulated is 31,360 plus 3,456 and the book value is cost, which is 40,000 minus accumulated, which is 34,816. Now last year, in last year we will have to take care of this residual value. this should be this should be the book value at the end of the last year, the last year of the useful life. So what we will do, we will simply deduct, we will not use any rate. Simply what we will have, this is our book value. Last year book value means current year book value, and resi- uh, we will deduct residual value, which is 5,000. So depreciation expense is 184. Accumulated is 3,4,816 plus current year depreciation, which is 84. So this 35,000 is your accumulated depreciation, and the book value, which should be same as residual value. So the book value is cost minus accumulated depreciation. So here it is 5,000. This 5,000 is residual value, and this residual value is same as this is present. This is same in the case of straight line method. So this was 200% declining balance method. Now we are completing uh, 150%. Instead of 200%, we are doing it by 150% of declining balance method. The procedure is same. Here we will simply delete. Okay. So for 150%, here we have 30% rate based on straight line. So for this, we will use 30%. For this chart, when we are using 200% declining balance, we used 40%. Now for 150%, we use 30%. So this 40,000 cost multiplied by 30%. So this is the depreciation expense. Accumulated depreciation is same 12,000, and the book value is cost, which is 40,000, minus cost minus accumulated depreciation, which is 12,000. So this was the book value at the end of the first year, or you can say at the start of the second year. So book value is 28,000 multiplied by rate of interest, rate of declining balance rate, or rate of depreciation is 30%. So this is the depreciation for second year, and accumulated is 12,000 plus current year 8,400, and the book value is 40,000 minus 20400. Next year, the third year, the book value is, we can take book value from the last year book value and multiply by rate, which is 30%. So the depreciation is 5880, and the accumulated depreciation is 20400, and we will add current year depreciation. So this is your depreciation, accumulated depreciation, and the cost minus accumulated depreciation. So this is your book value at the end of the third year. Now, as it is written to switch on a straight line method, when it will maximize depreciation expense. Now you can say it has already maximized depreciation expense. So we will convert it, or we will switch it into, you can say, straight line method. So for straight line method, we have just one, the amount of depreciation will remain same throughout the year. So you can say right now we have 13,000 cost, or the book value. In a straight line formula, cost minus residual value. In this case, we have book value minus residual value. How much remaining life? Remaining life is 2 years. So we divide it by 2. So depreciation is 4360. Next year, depreciation also again 4360. And accumulated is 26 to 80 plus current year depreciation, which is 4360. So this is your accumulated, and book value is cost minus accumulated, which is 30640. Next year, accumulated depreciation is 30640 plus current year depreciation, which is 43 and 60. Now we have book value, which should be equal to the residual value, and here cost is 40,000. We will deduct accumulated depreciation. So this is your remaining book value, which should be equal to the residual value. Uh, Use any method, either straight line method, or reducing balance method, or declining balance method, any percentage, the value, the remaining book value at the end of the useful life should be equal to the your residual value. So that's it. And one of the thing that in part B is required, that what is the difference or similarities in these three methods. So first of all, the first method is entirely different from the next two methods. In first two method, which is a straight line based method, and depreciation is the same for all years. Or at the start of this lecture, we have learned that the depreciation expense remains same or divided evenly throughout the life of the asset. So 7,000 is same or it is constant for all years. Whereas in case of declining balance method, depreciation is higher in earlier years, and it is declining in the later years. The similar thing is that the residual value in all three cases are same, because this is the residual value 5,000. So 5,000 is same for all three methods. So that's it from this lecture. In the next lecture, we will start unit output method, which is also one of the very important method. So that's it. Take care, class.